Welcome to the Wells Fargo Monthly Economic Outlook. I'm Sarah House, and today I'm joined by our Chief Economist, Jay Bryson, to talk about how the most recent developments are shaping our outlook for the economy ahead. So Jay, a big theme this year has been that economic activity has held up pretty well, although inflation remains too high. So where are we right now in terms of growth and inflation?
So Sarah, let's start with the first thing there in terms of growth. Where are we right now? So just to kind of level set, if you look at the second quarter, real GDP grew at an annualized rate of roughly 2% or so. We don't have the third quarter data as of this right now, but it looks like it's going to probably be double that, probably close to 4%. So, in general, the economy's holding up. And, what I would say is that when you look at it, when you look at the different spending components, it's broad-based. Consumer spending in the third quarter was, quite strong. Investment spending, probably not quite as strong, but probably you're still looking at some gains there. Net exports probably made a positive contribution as well. So again, it's, kind of broad-based. And then if you look at the employment situation, what you're seeing there is in the third quarter, on a monthly basis, we created roughly 260,000 jobs per month over that period of time. And again, just the level set in the second quarter, that was only about 200,000 or so. You talk about inflation, we've actually made progress there. So the Federal Reserve thinks that probably the best measure of the underlying trend of inflation is what's called the core PCE deflator. I'm not going to get into the technical differences between that and CPI inflation. They're very, very similar. But if you look at where we were a year ago on a year-over-year basis, that measure of consumer price inflation was running about 5.5%. The most recent reading we had was for August. It was below 4. It was 3.9%. And then, more importantly, if you look at the last 3 months, so this would be August relative to May, and you annualize that rate of pace, it was only 2.2%. So we are almost back to where the Fed wants it to be, roughly at 2%. So in general, the data that we've gotten recently shows the economy's holding up reasonably well, and that inflation is returning back towards target. So given that, what sort of changes have we made to our forecast since last month?
Well, I think given that ongoing strength, so we have made some upward revisions to our forecast. So you mentioned our third quarter estimates. So we're now looking at growth will probably come in above 4% on annualized rate here in Q4. So that was compared to, I think we were at 3.4 last quarter. But I think just beyond the quarter that just wrapped up, we are looking for somewhat stronger momentum ahead. And we do expect growth to continue over the next couple quarters. And a big part of that is the strength in the labor market that you've seen. So we've upwardly revised our expectations for non-farm payroll growth over the next 2 quarters. So our average monthly estimate is essentially double what we had last month, just given not just the very strong jobs numbers we saw for September, but also the upward revision suggesting that momentum does remain stronger there. And that's going to be very important for consumer spending. So for most households, their spending power relies on the labor market. And so that ongoing strength there we think is going to help support consumer spending and keep that positive over the next few quarters. So when we look at overall GDP, we think that for Q4 and Q1, the growth rates there will probably average close to about 1% annualized. So that is stronger than what we had before. And when I think about what this means for the Fed, given that growth is holding up, and importantly, the labor market is too. So they're still not having to worry too much about what the inflation fight is doing to the labor market. I think that suggests that we'll probably get somewhat later easing from the Fed. So we also push back the timing of when we expect that first rate cut from late in the first quarter to likely late in the second quarter. So given that more upbeat assessment on the economy, can you maybe explain why recession still remains our base case to our viewers?
Yeah, that's a really good question. And I guess what I would say, Sarah, is I don't know if we have as strong a conviction about an actual economic downturn today as we would have had, say, 6 or 7, 8 months ago, right? When the Fed was in hyperdrive in terms of jacking up interest rates, when inflation was higher than it is today. We still think it's our base case, and I'll get to that in just a second. But again, I don't think the conviction is as strong as what it was. The reason why it's still in there is, you mentioned about the Fed, not easing anytime soon. And we think they're probably done at this point, but they're not going to ease. And so what's going to happen is what really matters for the real economy is not that nominal Fed funds rate, which is roughly 5.5%. What really matters for the real economy is what's called the real Fed funds rate. So this would be that Fed funds rate minus an inflation rate, okay? And so as inflation continues to come down in coming months, but as the Fed remains on hold, that real Fed funds rate is going to drift higher. And so that's going to exert more and more headwinds on economic growth. Plus, on top of that, what we've seen is recently there's been a big backup in the long end of the Treasury curve. And so you think of, say, for example, mortgage rates right now. Mortgage rates are roughly around 7.5%. What's that going to do to the housing market? It's probably not going to stimulate it, right? And then the same sort of thing when you look at corporate bond yields. We've seen a rise in corporate bond yields. That's probably a headwind on investment spending coming forward. And so we still have a modest downturn in our forecast. Peak to trough decline of roughly 0.5%. And just to put that in perspective, that would be one of the shallowest recessions we've ever had in the U.S. economy. If you look over the last, there's been 12 since the end of the Second World War. I think they've averaged roughly 2.5%. So if you're looking at 0.5%, that's relatively too small. Again, I think what we have is a stronger conviction of whether or not we have an actual what is called a recession or not. One way or another, we think growth in the next few quarters is going to be kind of lousy. It's not going to be 2 or 3%. You have tight monetary policy, tight financial conditions. That's a headwind on growth. And so whether the economy contracts by 0.5% or whether it actually managed to eke out a gain of 0.5%, I think most business people would say, so what? What's the difference? It's slow. It's lousy. And the Fed has to slow the economy enough to bring inflation back to 2% on a sustained basis. Yes, we're making progress, but whether or not it's sustainable or not really depends. And I think the Fed's going to be very slow to bring down rates because they want to make sure we get back to 2%. So, and again, we have a recession in our forecast, but our real strong conviction is that slow pace of growth, whether it's negative or positive.
Well, thank you, Jay. And from all of us at Wells Fargo, thanks for tuning in to our latest monthly economic outlook.